watching Stockwatch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Just before the show started, I was telling you how full I am because I just ate. And actually, that's what the gold counters have been doing. They're quite full. They've been eating. So let's start off with them. Gold stocks printing cash. Harmony production update spectacular, 11 billion rand cash in bank. Are gold stocks still good value? Looking at gold stocks right now, JP, what do you think?
Zinati, sorry to burst your bubble. At least I won't be affecting your appetite, but I'm not a gold mining fan. So yes, they've done well. Yes, 10 billion rand of cash on the balance sheet sounds like a lot of money. But keep in mind that Harmony's market cap is 186 billion rand. So it is roughly 6% of the company's market cap in cash. And gold miners use a lot of cash as well. As they go deeper, the capex increases. So I'm still of the view that what we've seen in the gold price is more a reflection of what's happening in the US and geopolitical and trading shuffles and skirmishes going on. But if and when things subside, then you could see not only the gold price, but specifically the gold miners come down again, because historically, these are not great businesses. They don't control the cost of the product that they dig out of the ground. They are exposed to the vagaries of world markets. And that means that on a long-term basis, they don't sustainably make good profits. So yes, they're making profits now. Enjoy it while you can, but make sure that you need to leave the ball before before your profits turn into pumpkins, I would say.
Before I get to you, Grant, you said that you're not a fan of gold miners, but would you be a fan of any other gold investments at this time to take advantage of what's going on?
Yes, so the only one is gold mine royalty companies. They don't have operating costs, and they are effectively a stream based on the gold price over the long term without the cost issues that gold miners have. So I like the streaming companies more, the royalty companies. And there's a few listed in the US, but none locally.
All right. Your take, Grant, because, I mean, yeah, as much as JP talks about the operational risk, but they really, really have been printing cash. How would you be looking at gold and gold exposure at this point?
Yeah, it's a tricky one because we've been bullish or constructive on gold for probably 2 years now. But what I would say is that I'm starting to see the hallmarks of things that mark the upper end of cycles, at least in the short term. You're starting to see corporate action pick up. Yeah. Goldfields doing another deal. Yes, they are printing cash at these levels. If gold stays here, they're actually still cheap. But that's a big if. I think short term, we probably do some kind of correction. Longer term, though, I think there's large structural shifts happening in the global economy that are going to support gold. And I don't think we go back to a $2,000 gold price. I don't see it happening, but I could be wrong. And so I wouldn't be buying gold now necessarily, unless you want to use it as your portfolio diversifier, your kind of uncorrelated asset. And I think it still has that place, but it helps if you've held it for a while, as opposed to moving in now, because you do have a lot of timing risk if you're looking at it now, I would say.
Grant, let me actually ask you this question, since JP is not a fan of the gold miners. Pan-African Resources, if you can make 800% profit on Pan-African Resources, would you take the profit or rather wait for the end of year dividend?
No, definitely. They're not going to pay you they're not going to pay you all of your gains in a dividend. So don't worry about the dividend. Take your money off the table, or at least resize your position. Your position would have gone up 8 times. So now, if it was 5% in your portfolio, it's a much larger position. Definitely take some money off the table, but you can still argue for some gold if it fits the sort of bigger picture of your diversified portfolio. So, okay. But don't be overweight, else you're asking for trouble.
All right. Well, let's go into another commodity counter, and that is Sasol. Of course, gents, you can't run away from Sasol. You know, every 2 days we
Every
get a
show.
question. Exactly.
Weekly.
Will Sasol ever release value for shareholders, or do we pay the price for trying to catch a falling knife in 2024? I bought at 130 per share. I don't even know where the price is. I think the last time I checked it was just above 60 Rand. JP, Sasol?
Yeah, I've been a broken record on this one. So if you think I'm negative gold miners, wait till you hear my view about Sasol. So no, I'm not very optimistic that shareholders will see a good return anytime soon. I've missed the gold mining opportunity, but at least I've got the short Sasol opportunity. And I still have my short. I still see that the terminal value of Sasol just goes lower as the oil price goes lower, as the environmental liabilities go up, as the coal quality goes down, as the gas reserves go down, as the chemical prices in the US move in the wrong direction. It's just shock. Talk about a company where everything is going wrong. That's Sasol. And such companies can be a deep value opportunity, but you need a catalyst for that to happen. And I don't see a catalyst anytime soon. But beware, because if there is a catalyst, let's say the oil price spikes, that's the only thing I can think of really, then Sasol can go up quite sharply from these levels because it is very cheap relative to the balance sheet. I just don't see them generating good return on that balance sheet.
Your take and your, I can just imagine the hurt that the viewer's pocket has gone through from 130 to above 62 Rand. But it seems to kind of have stabilized on that level. Grant, do you think that it can get any worse?
Look, this one has been a classic value trap. I agree everything JP said. It's a really fundamentally challenged business from any number of angles, from management to operations to you name it, without repeating all of that. But what I will say is that historically the stock has looked dead and buried a few times in its life. If you think back to the 15 Rand price during COVID, when these extreme valuation lows come around, JP's brave to still be short here. We've reduced our underweight in this thing. I think you could maybe look at nibbling as a trade because the risk reward does start to skew in your favor. We've still got 2 wars on the go, or the Middle East is potentially still at war. We know Russia, Ukraine's at war. There's a lot of geopolitics at play, and oil at these lows might just kick up. But, it's not a compelling opportunity. Let me put it that way. I just think that maybe there's some deep value you could, for the brave or the patient.
And you know what I'm noticing, actually, the people that still have a hope in Sasol are people that made money from the spike in the share price after investing in COVID. I was talking to a friend of mine, and he actually bought his mom a house from the profits that he got from Sasol. And literally, when he looks at the share price right now, he's like, yeah, I'm going to enter again. But it's quite interesting because the environment is not the same as it was back then. Well, let's go into another counter that a lot of people have asked if it is a value trap, and that is Pick n Pay. Before I go into the influence of Boxer, there's a question for you, JP. Is Pick n Pay a value trap stock?
You're picking all my non-favorites tonight, Sunati. So, yes, again, I'm not very positive Pick n Pay. Don't worry, there are many shares I'm positive about. It's just between gold miners, Sasol, and Pick n Pay, not so much. So I still think that strategically, they're in a difficult situation. They need to spend a lot of capex. The hypermarket model, I'm still scratching my head if that really works the way that delivery is going in the grocery market. They're actually pulling back from delivery, which I'm really surprised about because it seems like that's the growth area, not just in South Africa, but internationally. And I'm just going to do it in certain metros in a 50-kilometer radius. Yes, they still have the agreement with Mr. D, but for me, the future of retail is in convenience, and convenience is going to be in the form of delivery. And Checkers 6060 showing that. So Boxer is the only part of Pick n Pay I really like, and now I can buy it directly. So therefore, I'm not interested in buying Pick n Pay. I'd rather buy Boxer.
I'll tell you when I got the shock of my life was I was comparing the pricing of a face cream on Checker 6060 and ASAP, and on ASAP it was 50 Rand more than Checkers.
Wow.
So yeah, I have proof. But anyway, Grant, your take. And actually, the second part of that question is if you see the financial results of Boxer on the 12th of May being positive, I guess, for Pick n Pay and both Boxer. I think the last time they took out a statement was a trading statement of some sort. It was colorless, though. I think it was in February. Grant?
Around Boxer, it's great business. I still think you can own it. I think they have a nice growth runway, etc., ahead of them. So high quality management as well. As for Pick n Pay, I don't see evidence of a good strategy of being executed. This pullback from the online delivery is a real concern. I mean, they're ceding already far behind Shoprite, and now they're ceding even more market share, which tells you their current strategy is not working. So they've got to rethink that, and they're far behind. So that's just one example. The store refurbishment is an expensive exercise. I think they've got a long way to go before it's obvious that they're turning the ship around. And I don't think it's any urgency to own this one until you see more evidence of some delivery on that front.
I mean, we're talking about, big catalysts turning around some of the struggling counters like Sasol, for example. JP, would there be any catalyst that could actually push Pick n Pay to a higher level than it is right now?
Definitely. For most companies that get very cheap and for a long time do very badly, one catalyst is very good cash generation. So part of the problem that got Pick n Pay to where it got to was because it had very bad cash generation. The working capital went out, and they paid too much in terms of dividends to the family. And if they can turn that around, if they can bring the working capital cycle under control, get back to negative working capital, which is a good thing for a retailer, and get the balance sheet right, which the double rights issue helped, but I think people would still like to see a good dent in that debt at the next results presentation of Pick n Pay. That can be a catalyst. And then together with that, the top line. So they need to grow revenue at a higher rate. They're not growing the revenue at a high enough rate. And there's all kinds of reasons for that, but it basically, we're consumers. We can look at it from the consumer perspective. If I can choose between buying my face screen on ASAP for 50 Rand more expensive, or buying it on Checker 6060, or going to Spar or Woolies Food, if Pick n Pay isn't one of my first choices and it's not front of mind for the consumer, the company and the shares will struggle. So as a consumer, we can sort of monitor the turnaround by just thinking about how does Pick n Pay stack up in our ranking of which companies, which stores we would go to buy our food.
Yeah, very, very interesting insights there. Right, gents, let us get to Naspers. I'm up 162% on my 50 Naspers shares, with the share price now close to 5,100. Is there any upside left in the share to even go higher? While I'd like to sell and cash in on the 158,000 profit, I really don't want to sell it because it's a solid company with a steady future. Grant?
Yeah, I think the viewer answered his own question. This is a good business. Tencent is a great business. And they're actually also focusing on the remaining pieces in the business, food delivery, and some of those other key verticals. And they're doing a better job now than they've done in the past. So I don't think the share is expensive. I think the outlook is very positive. So it's a stock I would definitely hold in a South African portfolio without question. Even in a global portfolio, Tencent, I think, can hold its own against the global peers on a valuation and a company quality basis. However, when you've made a nice profit, you can take a little bit off the table, but don't sell out of the stock completely, because it's one of those you never know when and how to get back in. So good businesses, you want to try and at least give them time to continue to deliver that compounding for you.
Okay. JP, how do you deal with the dilemma of a great company that has great fundamentals, but then you've made a lot of money and you're thinking of giving yourself some money back?
Yes, great questions, Anati. So the most expensive mistake that investors make are mistakes of omission. It's the mistake effectively of not holding onto a great share. And it happens very often. So there are many tales of investors that become very rich, but those are the tales of the investors who generally did not sell great companies, even after they made 100%, 200%, 300%, 400%. If it's a great company and there's no reason to sell it, don't. So yes, if you really think it's burning a hole in your pocket, trim a little bit, but you need to monitor the quality of the company. That's the most important thing you should do. And if there's no significant reason for you to believe that the company has lost its competitive advantage, its reason for compounding returns at a high rate, then don't sell. Don't sell just because the share has gone up, because that is the most expensive mistake you can make. If Jeff Bezos did this 20 to 30 years ago, after he made 100% on his Amazon shares, we wouldn't be talking about him and people going to space on Blue Origin. If Warren Buffett sold his shares in Berkshire Hathaway 60 years ago after making 100 or 200%, no one would know who he is. And the reason we know about these people and why they are the richest people in the world is because they had a stake in a business and they didn't sell. They held on and they compounded returns. So if you can find those ones, and that's very difficult, but if you can find those great quality companies, don't sell. Hold on for the long term.
Yeah, all right. We'll talk about expensive mistakes. We know that someone made an expensive mistake in the contract that Aspen is in a dispute with, in terms of what is mRNA contract. But of course, we saw the share price taking a knock. The viewers is asking, tell me if Aspen is a buy at current level of just below 120. Is that a call to make at this point without clear information, Grant?
You know what? I think this information blindsided a lot of investors, and I don't have enough visibility. I wouldn't be rushing here. I would like some visibility. Look, they have a lot of capacity, but they need to use it. They need to sell it, and this is a big knock for them. It might be an opportunity, but I don't see it as it's not clear and obvious to me that that you should be buying it here with confidence. So you also have to ask yourself, what is the rest of the business worth if they don't refill this manufacturing capacity anytime soon? Does it detract from the rest of the business and the cash flows? And so I would be careful. Maybe have a punt if you like it, but just more treat it as a trade with a stop loss, just to avoid any unwanted outcomes.
Well, as we were talking about Catalyst, JP, earlier, is there any get out of jail card for Aspen?
I don't see it. This contract was a take or pay contract. Now, take or pay contracts are effectively, if the client did not give the volume, the order of the volume, and still needed to take the capacity, it's 100% profit that they paid for this. So take or pay contracts are extremely profitable. And that is why generally, if someone enters into it and they're not ordering, they will do anything to get out of it because they are just paying away money for nothing to reserve capacity. So it's a big loss for Aspen because it was a take or pay contract. Yes, there's a dispute, but if one takes the conservative view and say Aspen is not going to win that dispute, then I agree with Grant to say I don't think there's a reason to be involved. Aspen shares aren't cheap enough to fall in the deep value category yet.
Okay.
And they do have significant debt and intangible assets, which are prone to write-downs. So I would wait to see what the balance sheet looks like after the June results. I think it's going to be important to see not just what the income statement looks like, but the balance sheet looks like and what write-downs we'll have on some of those intangible assets at the year end when the auditors scrutinize the numbers.
All right, let's go into banking. African Bank plans to list in 2027. Do you think this bank listing is going to steal Capitec's lunch? And should I start dumping my stake in Capitec from now till 2027 and go all in African Bank? Kennedy Bungane is doing a good job there. Quite an interesting one, Grant. Your take.
Yeah, it's actually a really interesting question. The first thing I would note is back to the Naspers question. Capitec is one of the best quality businesses in the country and one of the better banks in the world. So I would not sell it. I would hold on to that. It's one of those long-term quality compounders that you need to keep in your portfolio. if you've made a huge amount of profit, you can maybe take a little bit off and buy some African bank. As to whether they take their market share, I think, as I'm not close to African Bank, but I think they are still playing in the traditional space where they were 10, 15, 20 years ago. Capitec has evolved dramatically, and since then they've diversified the business, the revenue streams phenomenally well. And I don't think that these guys will be able to eat their lunch at all. I don't think they'll be able to catch up with them. There might be some at the margin competition, but I don't think it's going to move the needle. That's my personal view. JP's closer to that one, so maybe he can offer a different insight. But I wouldn't sell Capitec, and maybe Abel's a good buy.
I know you like Capitec, JP, but how would you read African Bank in terms of playing in the same sandbox as Capitec?
Well, is it the same sandbox? If you look at Capitec today, more than half the money, the majority of the profits are actually made in non-lending activities. Value-added services, insurance, transaction income, not the lending margin. While African Bank is still very far behind that journey and still makes the majority of their profits from lending activities. Although I must add, in the last 2 years, they've actually made losses from lending. It was only the insurance operations that caused the group to make a profit. So maybe the jury's out on that. But whether it's discipline and when it comes to lending, or it is the other services outside of lending, Capitec is streets ahead. It's not a bank anymore. It's a financial services business based on data and based on a platform. And because of that, I would still back the winner and avoid that most expensive mistake of selling winners just because the price has gone up and it looks expensive.
All right. A specific one for you, JP. Are you long or short on any Australian or New Zealand shares?
We do have a few Australian shares. We held one New Zealand shares a few years ago, A2 Milk. We've since sold that. We hold some shares like Acrobat Leisure. They make gambling equipment in Australia. And RIA, it's a real estate online platform, almost like a private property in South Africa. And 3 or 4 other Australian companies. So yes, we do have some Australian exposure in our funds long, yes.
Before we go to your stock picks, there's a question on Roinet. Is it a good buy? Grant?
You know, it's not one I follow closely. I think they've done a really good job over the last few years. I anecdotally follow them. I can't give it a really insightful opinion on it.
All right. JP, your take?
Look, they could benefit if we get electrical distribution at the municipal level going again, less corruption, less tender shenanigans, more money actually going for cabling, which is where Roinet has exposure. Office automation, I wonder about that business, especially if you think about these days, everything being electronic rather than being printed with printers. Their communication business, ITC business is solid, generates a lot of cash. So it's a stable business, Roinet. I don't have a strong opinion either way. I think it's just a solid, stable business.
All right. Well, other businesses that you gents think are solid, your stock picks for today, Grant, what are you picking?
It's a bit of a cheeky one. So I'm picking CIBR, which is an ETF. It's a cybersecurity ETF. So it's obvious from the recent updates from a number of the large tech companies, the AI rollout, the CapEx expansion remains very much in play. And of course, as we grow that utilization around the world and over the coming years, demand, they can't even meet demand, and cloud adoption, cybersecurity is absolutely critical. It's evolving, criminal activity is evolving with it using AI. So I think it's a non-negotiable. I think it's one of those areas that is going to continue to grow at a rapid pace. And this is a great way to just not have to pick the winner. So whether you're getting Palo Alto, you're getting CrowdStrike, you're getting Cloudflare, you're getting a handful of high quality cybersecurity businesses to capture that long-term trajectory without having to pick a single winner.
All right. Well, what is your winner today, JP?
I hope it's going to be a long-term winner, Zanati. It has been for the last 5 and 10 years, very good returns. It's HCA Healthcare. And the HCA historically stood for Healthcare Corporation or Hospital Corporation of America, rather. And it's in the name. What they do is they own more than 180 hospitals in the US and some in the UK as well, plus more than 2,000 other clinics, emergency units, and other healthcare facilities. And in a market that's very uncertain, you go back to things that are more stable. And the demand for healthcare is relatively stable. Unfortunately, people always get sick. There are always accidents. There's always babies that need to be born, even though less these days than some years ago. And that means there's always demand for healthcare. It might only increase 1 or 2% per annum, but HCA has got roughly a quarter of the US hospital market, so they're a dominant player, big player. There are changes. The politicians are looking at the health insurers. So I think that puts the healthcare providers, the hospital owners, in a stronger relative position. And if you are big and you can negotiate good rate with the insurers, and you have demand, which is very solid, increasing 1 to 2%, you've got a good business. So they come out with good quarterly results 2 weeks ago. And in an uncertain environment, I'm going to healthcare, to a hospital owner like HCA Healthcare.
Well, thank you for that healthy analysis, gents. Really do appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.